Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. It was a very tough week for Wall and Bay Streets, while the Canuck buck sank faster than a cast iron anchor in the Atlantic. Eric Hadik, CEO and president of InsideTrackTrading.com, checks in from California to talk about the cycles affecting the U.S. dollar, interest rates, stock markets, gold, and cryptocurrencies. KaiserResearch.com's John Kaiser gives us a look into EVs, battery metals, rare earths, copper, uranium, and the possible invasion of Taiwan by China. At the end of the program, we'll have a company showcase tribute to Larry Reaugh, the late CEO of American Manganese, now doing business as Recyclical Battery Materials. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at Charts by Ross. Welcome back to the show, Ross.
Well, it's quite something to be back again here, and it's a day with a lot of red on the board, and the blood is starting to flow in the streets here. I think while the sentiment was turning negative on just a slowly accelerating level for the last couple of weeks, this last 3 or 4 days has really taken the markets out to the woodshed.
So, how bad was the damage on Wall Street and also in Toronto?
Okay, so we're looking at markets that are now down in the 20 to 25% bracket off the highs. So, this is what you would look for just in a hard correction in the market, but we're not into what you would expect when you finally get into major market lows at the end of a bear market. So, for all that, a number of these indices like the Dow, the S&P, Toronto are back down and testing the lows that we had in the summer. Probably just going to see dead cat bounces. I mean, we thought that maybe the 20-week or the 20-day moving average was going to present some resistance on a bounce. At this point, I think we've got to be looking at lower levels, because the panic that's starting to set in here, I think, will become quite climactic in the near term. And when we look at what's going on the interest rate side of things, the short and long-term rates, we've seen this significant move that accelerated after the 3/4 point move by the Fed this week. And for all that some people thought that might have already been priced into the market, including maybe the next 2 rate increases. The vulnerability that's out there right now, I think that you're going to see more weakness as far as the equity markets is concerned after a bounce. Bond market, and when we look at like the 2-year, the 5-year, the 10-year bonds, those are all excessive enough that and the type of levels that we've only seen maybe 5 or 6 times in the last 40 years. Those are probably setting up for a reversal here pretty quickly.
The last time I checked, the Canuck buck took it on the chin, I think, on Friday, losing around half a cent.
I think it actually ended up being more like 3/4 of a cent.
Wow.
So it is.
That is.
You take a look at all of these currencies. The U.S. So what do we got? 73.55 closing level on the spot Canada as of today, the close of the week. And this was a week and a half ago. We were at 77 cents, and just in it's like the equity market. We were in this slow grinding down type of channel, and then in this last 5 or 6 days, the momentum has grown as the U.S. dollar has just gone, sort of ballistic on the upside. We're at 113 on the dollar index. That was 108 2.5 weeks ago. And in currency moves, these are significant bits of action. The monthly chart on the dollar index was for September was pushing up into an exhaustion mode for us, so that's an extremely overbought reading. I hadn't seen one of those since 2015, and usually what happens is that you'll have 1 or 2 months of these high readings, and then you'll get a hard correction. So wouldn't be at all surprised that October ends up maybe being the high for the move, and with a reversal coming at some point during that month. The daily charts also now, with this move just in the last 3 days, we've gone 110 up to 113. So starting to see excesses there, and that would be at the top of the channel as well. So the for all that things are, the momentum has really grown here. It probably going to run out of some steam reasonably soon.
What's going on the bond market?
Bond market, I've got lots of signals in here. We've been into sort of excesses on the downside for the better part of a month or so. But, you take a look at a long bond. We've gone from 144 down to 128. That's a huge move for the bond market. The yields up. Just had a little bit of a turn on Friday, and the excesses that they're sitting there in that bond market, wouldn't be surprised there that we've had now 3 days since from the Fed move, and for all that the Fed is a headline item with their 3/4 point move, they're just following what was going on in the open market anyway. So we'll just see what the bond market wants to do independent of the Fed, and I think a bounce here in bonds is pretty realistic at this point.
Is it surprising the Canadian dollar fell so much, or is it because crude's going down too?
Well, I think, the crude was definitely, the catalyst within all that was happening. Here we're down just 5% on the day on the crude oil, closing off at about 79.25. Did, during the day, actually get down, into the 78 range. When we look, we have a model that looks at a 10-year cycle, and on crude oil, and because of COVID, the 10-year cycle has actually shifted by about 6 to 9 months in this last move. But if we go back in the preceding ones, the tops of the runs, like we had in this case, up to $130. Were followed by an ABC style of correction. So you get the first hard break, you go back and retrace 50% or more of the initial drop. So in this case, crude had gone from 130 down to about 95, bounced back to 120 in June, and we're now getting the second leg to the downside. And when you measure, and so this is the same pattern that we've seen in the previous 3 cycles of that 10-year cycle. And at this point, when you measure the size of the top that we've come out of, the measurement is down to about 76 and change. So we're starting to see, enough here on the downside for crude, and sentiment is turning negative enough that, maybe 76 is going to be a reasonable spot to hold. The last important low that we had was just around, just under $70 back in December of 21. And, you might see a spike into there, but I think anything from 76 down is going to be a reasonable target at this point.
Ross, thank you so much for the update.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at chartsbyross. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, well, thanks for having me back, Jim.
How are things at Inside Track, and how can people subscribe?
Oh, I'd say things are going pretty well here. Gotten a lot of attention with some of the recent market moves and what had been forecast over the last 6 to 12 months. So I can't complain where that's concerned. But people can find out information and or subscribe, get access to some of our archives, reports, and whatnot, all at the same location, our primary website of InsideTrackTrading.com, spelled the extra I in the middle, so INSIIDE, TrackTrading.com.
Eric, the Federal Reserve just raised its central rate 0.75 of a point this week. What are you seeing ahead for interest rate cycles?
Nothing has really changed in the interest rate outlook and the broader cycles that I watch. And just to kind of reiterate and refresh, I know I've pointed these cycles out many times in our conversation, but you have a very consistent 4-year cycle that had times previous highs in bonds and notes, which are, inversely the lows in interest rates, back in 2008, 2012, 2016, and coming into middle of 2020, I was explaining and detailing why a major multi-year top should be seen in bonds and notes and a corresponding multi-year low in interest rates. And that from that point forward, from mid-2020, we should see at least a 2 to 2.5 year rise in interest rates and drop in bonds due to this cycle and a lot of corroborating cycles. Whenever I'm looking at any market, any group of markets, I want to see synergy in cycles and then corroborating indicators. Cycles really just lay the foundation or set the backdrop for other more precise indicators that I use to validate them. But all that to say that interest rates were forecast, and that was back, ironically, at a time when you can find quotes from Fed Chairman Powell talking about that the markets need a little bit of inflationary influences to help them out. And that was just at the time when all the cycles in inflation too were saying that we should have a couple year upswing and also an interest rate. So it has followed that pretty closely, and we're coming into a time frame here where I think we're going to see an initial bottom in bonds and notes, an initial top in rates or the perception of rates, even though this past week there was so much hawkish talk as well as the rate hike. I think now you're going to get into this time frame where over the coming months you start to see some competing economic numbers. You start to see inflation peaking a bit, and you probably, along with that, you'll get traders' perceptions start to swing a little bit where, okay, maybe the Fed is overdoing it or a little too fast and too aggressive on all the rate hikes. and start pricing that into the market.
Where does the stock market crash of 2020 fit into the 40-year cycle?
The crash of early 2020 was really a precursor to a much more significant top and sell-off beginning in early 2022. Back in 2019 and leading into early 2020, I was describing how you've seen a sequence for over 100 years, a sequence of 11-year cycle, what I called stock panic cycle and global shaping events. I still have some reports that I did in 2019 posted on our website that explained why the end of 2019, beginning of early 2020 should usher in a global shaping event, which I kind of detailed ones in the past and what they had done and how they had impacted global markets and whatnot for years to follow. And at the same time, I was expecting a sharp stock panic in early 2020 based on this 11-year cycle. And so the introduction of COVID and the sell-off of first quarter 2020 fulfilled that cycle very closely. Even back just to give an idea of this overlapping 11-year cycle, you can take it back to the previous one was 2008, 2009, and you had the whole financial real estate meltdown then. And prior to that was 1997, 98, when you had the Asian and then the ruble crisis, which had two stock market sell-offs in there. And prior to that was 86, 87, leading into the 87 crash in the market. Prior to that was 74, 75, where you had the culmination of a 2-year sell-off in the markets. And everything associated with that. And in these reports, I traced it back all the way to the 1860s and the Civil War, but every 11 years you had these type of market meltdowns, panic of 1873, depression of 1882 to 85. It just kind of kept going on, and everything was saying that late 2019, early 2020, we should see this, but in March of 2020, there was a number of cycles and indicators that showed we were at a bottom. My work generated some 6 to 12 month and 1 to 2 year buy signals that were published then, and I explained how we should see a final rally in some indexes into mid-2021 and a few remaining indexes into late 2021, early 2022 before the 40-year cycle would usher in what should be a much longer lasting peak in early 2022. So that early 2020 sell-off was much more of a precursor and a harbinger of something larger to come. But after one final leg up, it really was like a fourth wave. For any listeners that are familiar with Elliott wave, you often get a quick sharp pullback and then a rally to one final high before a much more significant peak is set.
There's a lot of worry out there. Could the stock market climb a wall of worry?
That's a good question, and there are certainly some time frames that I'm looking for the market to see some rebounds in here. But I think there are so many different competing but often corroborating worrying events out there that each time the market does do a little climbing, then it, suddenly hits a point where there's a little too much coming at it, and you see just what we've seen since the mid-August high, another round of selling. I think we still have more of that to come, but I think we are getting into a time frame where it's going to be a little more of a trading market, getting 2 to 4 weeks, sometimes 1 to 2 months, competing trends, down and then back up, et cetera. So the wall of worry, I think it's whenever there are some, appeasing or assuaging, factors that suddenly lessen a little bit of that worry, and you'll see the market rally, but, climbing the wall of worry itself, I don't think so.
Are there geopolitical cycles that can affect market cycles?
Oh, absolutely. And that's even what I was just, alluding to or discussing with those, cycles of global shaping events. And there are, I know I discussed with you for many years prior to this year, even the long-term 80-year cycle of war. And all of my work said that we should see that come back into play beginning in late 2021 and stretching all the way through late 2025. And the events in Russia, Ukraine were a perfect initial fulfillment of that. But I think we've got a couple more phases within this 4-year or so period that I think, there are still some big concerns and potentials out there surrounding China, South China Sea, Taiwan, all of that could certainly create a conflict in this amidst this war cycle. And even the Middle East, although it's been kind of quiet lately, the cycles are telling me that there could be something there in the next couple of years. So there are certainly different geopolitical cycles that reinforce a lot of the market cycles.
Where is the U.S. dollar cycle likely headed?
The dollar has had a very consistent 3.25-year cycle, and I look at that more from a monthly perspective. It's 38 to 41 months has been the duration of this very consistent cycle between peaks, between lows, and when it's in a bigger trend, between a high and a low or a low and a high. And that's what I explain with cycles, is that my cycle progression tool and indicator explained how you will get a cycle first governing successive lows for 3 or 4 or 5 phases, then it goes into a full trend that's the same duration as that cycle, and then the cycle ends up flipping and end up timing successive highs. And so the dollar has done that on this 38 to 41 month cycle, and the couple of peaks and lows that we've seen in the last 5-6 years were in perfect sync with that cycle. The most recent being early 2021, when the dollar was expected to set a multi-year low and enter at least a 2-year uptrend into early 2023, which is when the next 38 to 41 month cycle between highs comes into play. So we're right in the midst of that, and from a price perspective, well, first from a wave perspective, that 2021 low was perceived to be, it's what I discussed in several articles right around that time, a major fourth wave low in the dollar, and that's tracing this trend back to the bottom in 2008, where you saw an initial rally for about a year, then you saw about a 2+ year consolidation. You saw the 2-wave low come in 2011, and then the what's more dynamic 3-wave advance go into the peak in 2017, and since then, having that correction that we saw in there, it was ready for one final multi-year advance, and then I think the dollar is on track to set a major top next year. So while we're in a very bullish phase on a 1 to 2 year basis, I think we could also be coming into a multi-year top out in 2023.
Where is gold where it should be in its cycle?
Gold has that really factored in very closely to the 40-year cycle of currency wars that I discussed from 2016 to 2021, but also some many cycles that aren't that as long-term as that. But the whole outlook for gold was to see a 5 to 6 year rally from late 2015 into late 2020, early 2021. And then gold should go through a topping phase, which was validated even early this year when it spiked up into early March. And on its wave structure, that completed a textbook fifth wave advance from the late 2015 low. It fulfilled everything that was necessary to put in another 1 to 2 year top, and from there the initial support and downside objective when gold was hitting 2080, getting close to 2100, the initial downside objective was around 1680, which we've finally reached and are even starting to breach to the downside, which that helps to confirm what was already perceived about the early March top, that was a major top in gold, the way it even just retested the August 2020 peak and couldn't create any follow-through momentum. That just reinforced that gold was in a multi-year trading pattern, that really that late 2020 peak started a 2 to 3 year consolidation phase, even though that consolidation has big moves within it. But your initial decline into first quarter of 2021, then the overall rebound into first quarter of 2022, and now a new decline that I've been saying could last into the fourth quarter of this year. So that for gold, it's in a large corrective pattern. But the interesting thing I've been watching is this was the time frame starting in September where I thought silver would begin to overtake gold in the proportions of its rallies and start to become a little more of a focal point, and that the inflationary aspects and other factors would start to benefit silver more than gold from now and out over the next 1 to 2 years. And so, again, it's kind of this large trading range where you get 3 to 6 month trends in each direction. And so gold is still within that, and like I said, could wait until the fourth quarter before finally bottoming out.
Since last December, you've been saying that Bitcoin should continue lower into September 2022. Now that we're here, what do you see in store for cryptos?
This is a really pivotal, really decisive time in my work for Bitcoin and other cryptocurrency, when I think you have the best chance for a pretty significant bottom. In fact, I just put out a special update, a report for my subscribers that we offer as a value-added bonus to any new subscribers. But it describes that, it recaps what really helped pinpoint the peak last year, and recaps the series of cycles that I saw coming into play in September of 2022. So every month since late December, each of my monthly newsletters and several of my weekly ones have just repeated the same mantra, which a lot of Bitcoin bulls didn't want to hear, but that I thought that Bitcoin would continue lower until September of 2022. And among other things, that's when a 15-month cycle comes into play that timed lows in September of 2017, then December of 2018, then March of 2020, then June of 2021, and then it was untapped to set a subsequent low in September of 2022. So when Bitcoin fulfilled all of these wave objectives and major upside targets in late November last year, the focus shifted, and ever since then, the outlook has been for a drop into September of 2022. Along with that, you've had some very consistent weekly cycles that started to corroborate those monthly cycles, and a consistent 32 to 34 week cycle that has been governing Bitcoin. And that was telling me to look for the bottom to happen by or on September 23rd, so right where we are now. But along with those cycles, like I said, they lay the backdrop, but then I start to look for price action both within a market like Bitcoin, but also in corresponding markets like Ether. And Ether provided some early textbook wave movement leading into its June low, and since that time it recovered in a very consistent and somewhat textbook manner, and then entered, after peaking in mid-August, entered what I think is a two-wave pullback. So that means it would be expected to pull back, could even retest the June lows, but should not go below those June lows in Ether, whereas Bitcoin is spiking to new lows. And when you get that kind of divergence, that's often indicative of broader turning points in a whole market arena like cryptocurrency. So there's a lot of cycles lining up. There are some key price objectives that have been met in Bitcoin. One of the major retracement levels since that peak near 68,000 last year. When a market is going into a major decline but is not expected to take out its previous major bottom, it often retraces the same percentage, and this percentage is tied to the golden ratio, but it's not the golden ratio. But that had Bitcoin major support right around 17,800, and that is right where it has gotten down to, spiked below once or twice. And so from a price perspective, it's fulfilling downside targets. And now there is a series of shorter term patterns and indicators that I'm looking to kick in. They haven't yet identified a buy signal in Bitcoin, but they're kind of setting up for that, and it wouldn't surprise me to see them generated in the next few days. But until they are generated, it remains in a downtrend. That has to be kept in perspective as well. But I think this is a very decisive time for Bitcoin, and I think it could be a very opportune time for traders if and when Bitcoin generates these signals and confirms that a low is intact. And I even discussed in this report that I mentioned before some of the initial upside targets that we could see once a bottom is confirmed.
How do those cycles pinpoint last year's peak?
Well, one of the most significant ones that I saw, obviously Bitcoin has a very short history, so there's not these longer-term cycles that you see in a lot of other markets, but it started with the very broad 40-year cycle of currency wars that I kept talking about, and how your precious metals and then digital currency came into this whole battle between fiat currency and then some of the alternatives. So from a broad perspective, it was already setting the stage for a peak in 2021, along with that 40-year cycle that I talked about for 6-7 years consistently, that from 2016 to 2021, we would have this recurrence of a ongoing 40-year cycle that goes back centuries, even before it goes back to the founding of America, but then it goes back in Europe to the 1200s, where you can see these battles between hard currency and other alternatives, more recently fiat paper currency in the last couple centuries. So that broad perspective was telling me to look for a peak in 2021, but more specifically in Bitcoin, it was a very consistent 4-year cycle, which often when you have those long-term cycles, you'll get those kind of 10% cycles, so a 40-year cycle and a 4-year cycle. That 4-year cycle really has timed Bitcoin's history, starting from its origin in 2009, and then a very significant peak in November, December of 2013. And then you saw one of its next major peaks 4 years later in November, December of 2017. And that was along with a lot of the price and wave structure objectives that I discussed throughout 2021. That 4-year cycle was pinpointing November, December 2021 as the time for another major high in Bitcoin. So that was the broader cycle that was being watched leading into that time frame. From a wave structure, Bitcoin needed to see one more rally from May of 2021 up to and above its previous first quarter 2021 peak in order to complete a fifth wave rally. And when it was able to spike above its earlier 2021 highs in November of 2021, and it was fulfilling that 4-year cycle, and at the time weekly cycles were also converging, and you had divergent indicators that were showing underlying relative weakness. It was all those things combined, but the cycles were the ones leading the way that said, okay, we've hit the peak of the bubble. It's now time for this thing to burst, and that it should plunge into September of 2022. So, I mean, there's a lot of factors that really reinforce why this is such a critical time, in my opinion, and in the cycles that I watch and the price indicators that I use for Bitcoin and cryptocurrency.
Eric, where can people follow you and subscribe to Inside Track?
Well, once again, you can go to our primary website at insidetracktrading.com, spelled INSIIDE, tracktrading.com, and see a lot of samples of our publications, descriptions of the different publications we offer, and we also, one of my real primary objectives is to also offer somewhat of an educational perspective to the market and to using cycles and technical indicators in the market. So there are also a lot of tutorials and indicator explanations and illustrations on that website, try to make it fairly comprehensive so that new readers can come in and get a feel for not just what's expected in the market, but what is driving those expectations and how those readers can take these indicators and apply it to perhaps markets we don't cover, their own portfolios. So we want to offer, like I said, a more comprehensive approach to the market, not just describing what the cycles and price indicators are indicating, but how those conclusions have been reached. And so InsideTrackTrading.com is the best place to locate all that information.
Eric, thank you so much for being on This Week in Money.
Thank you for having me back, Jim. Always a pleasure.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from California. Coming up, John Kaiser next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Kaiser from Kaiser Research. John, welcome back to This Week in Money.
Jim, happy to be back on This Week in Money.
John, just how are things at Kaiser Research and on Kaiser Watch?
Well, Kaiser Research is an information platform that also serves as a commentary analysis vehicle for me to talk about resource juniors in particular. It's fee-based. It costs $450 US for an annual individual membership. And given how the markets have gone across the board this year, you can imagine that subscriptions are not rising, and we are seeing attrition in members as people just give up in despair that we're ever going to get a major bull cycle in the resource juniors again. Kaiser Watch, which is the free version that includes the so-called KRO favorites, which are unrestricted, that's actually doing quite well. I've managed to do an episode every week of this year so far, and that's accumulated about 400 subscribers on YouTube and gets a fair amount of interest, has a pretty good following. I use Twitter, where there's several thousand followers to whom I tweet the link when it's available, and presumably they are also in some form or other following my observations about what's going on in the resource sector. The big theme that I'm talking about these days is the outlook is so bleak for everything that I've given up speculating about where gold is going or copper is going, because everything looks like a recession is in the wings. On Wednesday, Federal Reserve increased the interest rate 0.75 point, so the prime rate's now 6.25%. That's going to cause problems in the real estate markets before long. We're going to have a negative reverse wealth effect out there. So that means that economic demand's going to go down for metal. So it's really hard to get excited about anything that requires a stronger metal price. And of course, even though inflation is high, they will crush inflation eventually when they tank the economy, and that's not going to be particularly good for gold in the interim, so we're not getting any joy for gold. So my focus has been on something that's unique. It's called emerging discoveries. It happens in this type of terrible bear market where the glass is worse than half empty. It's 90% empty, and companies can put out news that isn't a blockbuster, no-brainer drill intersection, but has very important information that they are at the beginning of what, with some more drilling, could turn into a major discovery. And these types of companies I'm now on the prowl for, flagging them, mentioning to my subscribers, because when they get that next drill intersection where it's suddenly confirmed, these types of plays become standalone bubbles with participants coming in from everywhere. Nobody cares what the general economy is doing, nor do they care what the the metal price trends are, because the whole point of an emerging discovery that gets confirmed as a real discovery is that the grades and size implications are such that it works with the metal prices that we already have. So although it's dreary in terms of subscription revenues, Kaiser Research is having, and the members that it still has are having a lot of fun looking at the landscape of these companies that are still drilling holes and coming up with news that in a better market would cause the stock to double or triple, but nowadays merely makes them move up a little bit and gives us a window to accumulate a position ahead of the resumption of drilling.
Is the Inflation Reduction Act good for the electric vehicle battery metal sector?
The Inflation Reduction Act and a sister bill, the CHIPS Act, $380 billion bill, both of them signal a return to industrial policy, which is the government from top down setting policy that affects the interests of the country rather than just leaving everything to the free market capitalist system. Other countries like Russia and China clearly use industrial policy to shape the direction of their economy and the prosperity of their nations. And we're seeing something similar now start to happen, and neither Democrats nor Republicans were ever very keen about this because it was like, yeah, let the free markets figure it out, everything is better. Donald Trump actually initiated this. He was the one that recognized that globalization had basically wandered to its own extinction and started pushing industrial policy. But then Biden has picked up from where he left off. Now, in the case of the Inflation Reduction Act, it includes a part of it is about encouraging the energy transition to a clean energy foundation away from fossil fuel combustion that loads the atmosphere with carbon dioxide. But it also includes a provision that cars that get these, the electric vehicles that get these credits, that they must source their materials in nations that are friendly to the United States. And at the moment, neither Russia nor China are friendly to the United States, and Russia and China together dominate of the 30 or 40 or so key raw materials. They together represent more than 40% supply in about half of these metals. So China and Russia, they are a key source of all these materials that go into these electric vehicles. And so this bill is good because Canada is going to be a major supplier of a lot of key metals such as lithium, which are essential to the generation of cars that are going to emerge over the next 15 years, especially if other states follow California's initiative in mandating that by 2035, no internal combustion engine car, new sales of them will be allowed. This transition requires an awful lot more of these critical minerals. Canada itself, it has introduced a 30% tax credit for metals designated as critical to encourage exploration and development. So this act in the United States, which stipulates that you can't just get your metals from the lowest cost jurisdiction with horrid autocratic regimes in charge, this is going to be good for the resource juniors, especially given my view that Eastern Canada is going to undergo a very big exploration boom for lithium to come up with the second half of the tenfold expansion in lithium supply that will be required by 2035 to make EV replacement of ICE cars a reality. And the other reason it's important is I don't think the United States is ever going to get out of its not in my backyard syndrome. Almost every project in the United States gets bogged down. Even one in Minnesota, Talon Metals, the Tamarack project, has people protesting saying we don't want this hole in this hole in the ground, even though it produces nickel for the future battery market. And Canada has also its problems. It has First Nations issues. Some First Nations groups are eager to see development in their backyard and participate in the prosperity that comes with that. But others have been hijacked by the NGO crowd that really doesn't want to extract metals, but they're perfectly happy to call for the energy transition and have other countries where the production is very dirty and abusive deliver it. That whole attitude is on the way out. So I think the Inflation Reduction Act is a very positive development. The CHIPS Act, which realizes that the dependency on the lowest cost jurisdiction, especially in proximity to China, that's going to also it's telling the world that we need to reshore production closer to home and in countries that are likely to stay the allies of the United States. And Canada is definitely in that category. So yeah, I think it's going to be good for the battery metal sector and the juniors.
Is access to battery metals going to be key for the makers of electric vehicles?
It's going to be very important. We had to laugh a few weeks ago when we had the heat dome come over California, finally hit us with 100 to 110 degree temperatures, and the air conditioners were grinding away, and Gavin Newsom had to put out a plea saying, can you Tesla owners please charge your cars at night, not by day, so that we don't have the grid go down. California's decision to make it mandatory for no new internal combustion engine car sales by 2035, that also puts the spotlight on, okay, we are now required to make this reality. In a sense, it was already happening. The car makers have gone beyond the point of no return. They have committed to introducing electric vehicles much faster than anybody anticipated 6 years ago when we first had all this EV mania get talked about in 2015-16. But now that with the government mandating it, now everybody's asking, where are you going to get the raw materials from? And right now, China is a big processor of lithium inputs, feedstocks to make lithium carbonate, the battery grade, hydroxide version 2 that's required by battery companies. And battery companies, of course, are based in Asia, but now they're being also based in North America. But they haven't really thought through where's the lithium going to come from that goes into these batteries. And all these rule changes, they're now making people think really hard. They're making them think, why does it take 8 to 10 years to build a mine in Canada, even though there are very strong environmental rules? What is going on here? Is it even physically possible to make this energy transition a reality? And the same thing with all the grid. If we do have all these electric cars plugging in 2035, is the grid going to be robust enough to supply the energy? So it's nice that now they're actually thinking about the logistics of how do we physically make this happen.
Could China-Taiwan concerns affect rare earths?
Rare earths are a serious problem still for the sector. In the last few years, production has gone from about 120, 150,000 tons per year, up to about 280,000 tons. The permanent magnets are a key part of the electric vehicle. China is no longer 85% of global supply. It's about 65, 70%, but it still is the dominant producer. And with this alliance that China has forged with Russia, basically endorsing Russia's invasion of Ukraine and supporting autocracy as the superior form of political organization, there is now a serious geopolitical tension. And that CHIPS Act that I mentioned earlier, that's part of the reaction to what if China just says enough is enough and annexes Taiwan, and what are we going to do, start World War III over that? Well, we probably will end up starting an economic war with China and completely decouple. And that's going to be a problem for the electric vehicle dreams if the rare earths still primarily come from China. So, yes, this Taiwan situation, if it continues to simmer and escalates, that's going to put a crimp in the supply of rare earths to make these electric vehicles a reality.
Are we likely to see Rare Earths Mania 2.0?
We will not see a mania like Mania 1.0 that played out in 2010 to 2012, because what that period did is it woke up people to the problem. The juniors, they were in the lead, scrambling, getting hold of all these projects that had been found ages ago, in some cases finding brand new rare earth deposits that are outside of China. But then China came to its senses and eliminated its quotas and allowed shipping of rare earths to Japan and all these other places, and they collapsed the rare earth price. And the rare earth prices had gone up 10-20-fold. They were insanely expensive. And we ended up back in a bear market. All these projects were worthless. But since then, the emergence of the electric vehicle and its much greater demand as a group than hybrids have for the permanent magnets, that has allowed the prices for the 4 key magnet rare earths, neodymium, praseodymium in the light category, and terbium and dysprosium in the heavy category, to recover to a point where now in any deposit, these 4 magnet rare earths represent 80 to 90% of the in situ value. And these prices can go even higher. They were maybe 30-40% higher in the first quarter of this year. They've had a bit of a pullback this year because of the slowdown in production in China for manufacturing that. Xi Jinping's zero COVID policy is a nightmare. 27 people died the other day when their bus where they were being shipped to some sort of quarantine went off a cliff just for this fanaticism. 27 people died in a province where since the start of COVID in 2020, only 2 people have managed to succumb to COVID. This has really disrupted supply chains in China, but we're starting to see the rare earth prices turn around. And there's lots of research being done also in other rare earth materials, because some of them like lanthanum and cerium, they are super cheap and abundant. They are the ones that are dominant, and yttrium in the case of heavy rare earth deposits. If new applications can be found for those, that could shore up their prices. And this will be key to making these deposits outside of China viable. And we're starting to see interest from the end users finally going upstream. In the Rare Earth Mania 1.0, they weren't interested in all at the upstream source of stuff. They were more interested in the processing of these materials. Now they understand we have to go to the source. We have to support the source, make sure that it's happening. So I think we will see a revival of interest in rare earth plays. We will not see the kind of crazy price spikes that we saw in 2010, 11. But I think rare earths are a group that are tied into the energy transition that are going to get a lot of interest from the market again after they became unloved in the 2013 to 2020 period, when rare earth prices ended up even lower than when they started at in 2009.
Are we likely to see Lithium Mania 2.0?
I would say absolutely, necessarily, definitely we will see Lithium Mania 2.0. And of course, 2.0 refers to the fact that we had a bit of a false mania back in 2015-16 when all the talk emerged about, electric vehicles are taking off, Tesla is selling these, people want these, the other car makers are fear of missing out is causing them to jump into the electric vehicle sector and invest billions of dollars making their own versions. And some of the analyses involving what goes into a lithium-ion battery, and at the moment it's really just in the electrolyte that lithium is used. They are predicting that if we truly have an electric vehicle replacement of internal combustion engines by 2035 to 2040, we will need to be producing about 1 million tons of lithium metal equivalent compared to 100,000 tons in 2021. And the Lithium Mania 1.0 flopped because the Australians realized, well, we have all these pegmatite deposits, especially in Western Australia, and they scrambled to develop them. And at the time, lithium prices were between $10 and $12 a pound for lithium carbonate. And at that price, these 1% plus lithium oxide deposits, they make a lot of money. And the Australians went to town, delivered new supply, and it was more than the market needed at the time. So the lithium carbonate price collapsed below $3 a pound, where none of these pegmatite deposits were. Meanwhile, also in the lithium triangle in South America, Bolivia is part of this Chile and Argentina triangle, but Bolivia's salars aren't really being developed because of a high magnesium content. But in Chile and Argentina, there's been a lot of activity ramping up the supply. But because much of this involves evaporation and direct lithium extraction, which is a new technology that processes the brines without having to evaporate the water, stripping out the lithium, that's an emerging technology that could make a big difference. But the lithium triangle cannot provide a tenfold expansion of supply as is required. And the Australian pegmatites, well, they're picking off the easy ones right now and developing them, but that's not going to deliver the 1 million tons needed. And Goldman Sachs thinks that China, with its lepidolite deposits and its own inferior brine deposits, could turn it into a big producer, just as happened in the 80s with zinc and molybdenum. But there's a lot of skepticism that the Chinese resources for lithium really have what it takes for China to dominate that. So that leaves open the possibility of Eastern Canada, where all these pegmatites were observed decades ago. They would be documented while exploring for gold and base metals. The academics would also take note of them and write their academic papers describing the occurrence for them. But 20 years ago, the lithium future was very modest. It was used mainly in glassware and ceramics, and nobody dreamed that the lithium-ion battery would end up becoming the basis for electric vehicles. Well, in the last couple of years, everything changed as the electric vehicle adoption really gained momentum, and now we have a supply imbalance. We have lithium carbonate at $30 to $35 a pound. That's too high. It doesn't need to be that high, and everybody's wringing their hands. Oh, it's going to collapse again and go down. Well, even if it goes back to $10 a pound, that's actually good news, because at $30 per pound, it's doubtful that we're going to see the masses adopt electric vehicles, because they'll simply be too expensive. They have to be affordable. But at $10 a pound, these pegmatites that are enriched in lithium, that are abundant in Eastern Canada, you need to just find them, peel away the moss, figure out how big they are, make sure there's no iron impurity in there at a level that's unacceptable to the battery lithium refineries, and start demonstrating that, yes, here's that missing half, what the lithium triangle and Australia cannot deliver to make the EV adoption a reality by 2035. So I think the next few years we're going to see a lot of buzz about exploration plays, and we've already seen Patriot battery metals. I mean, 5 years ago they had the Corvette project, but at $3 a pound lithium, it was not very interesting, and there was skepticism about whether EVs would actually be adopted. But now the stock has gone from next to nothing to $6 to $7. Just raised $20 million at double the price using the flow-through credits that the Canadian government has invented, and they're delineating large bodies within their 50-kilometer trend that are grading 1 to 3% lithium oxide. So this is going to be an emerging significant source of lithium for the North American market. And by itself, it won't be enough because you can only have so many mines at such a large scale, at a particular scale. You can't go beyond a certain scale. There will be multiple pegmatite mines feeding centralized hydroxide refineries in Eastern Canada. And this is the boom that's happening now. Companies are out there revisiting these areas with the right geology, using their NITOM guns to XRF units to shoot for the key marker mineral, rubidium, and then taking samples and seeing if it's got the grade. So we're heading into a 2 to 3 year exploration boom where some raggedy little junior with hundreds of millions of shares out could suddenly produce an intersection of 50 to 100 meters of 1.5% lithium oxide, and they can show that, well, this is a 15 to 20 million ton body at least, and away she goes. You get valuations from like $5 to $10 million implied value to hundreds of millions of dollars implied value. And this is like the lithium mania combined with this emerging discovery concept. That's going to be the boom that dominates the junior resource sector over the next few years.
What's happening with the demand for nickel?
Nickel is part of the cathode of the higher quality lithium ion battery that the car makers are using. There's a new type of battery that's inferior, the lithium iron phosphate battery, which is being used in China for lower end cars. It's doubtful that North Americans will be particularly interested in those types of cars. The Teslas are still going to be using the nickel manganese cathode, and to some degree spiked with cobalt for their lithium ion batteries. But nickel demand is going to be largely dictated by macroeconomic conditions. Stainless steel is still the primary usage for nickel. Nickel, battery grade nickel sulfate, that is the cathode material of choice right now. So there is market interest in projects where nickel sulfate can be made directly from the concentrate. Otherwise, you have to make it from refined nickel that's already been smelted, and that's in the LME warehouses. In Indonesia and Philippines, they bypass the warehouses. Those are laterite deposits. They make something called nickel pig iron there, and that's a big growing supply center. Indonesia stopped allowing raw ore to be shipped to China to be processed in China. They are now emerging as a major supplier, and the Chinese have adapted. But big question is the macroeconomic trend. The IMF shows the global GDP growing significantly between now and 2029. However, if this inflation battle spins out of control and the world topples into a major recession, they may have to dial that a bit. But nickel is going to be mainly tracking macroeconomic growth and to some degree the extra demand from the nickel-based cathodes for these lithium-ion batteries.
Could copper see a mania?
Copper is unlikely to see a mania. It's the electric vehicles use an awful lot of copper wire, and that's a new demand that will be layered on top of the macroeconomic-driven demand for copper. Now, the problem with copper is it's being set up for something similar to the 2000s. And when the China supercycle kicked in, the world was not prepared for China's GDP to grow from a couple $2 trillion to $15 trillion in the span of a decade. But that did happen, and the world was not equipped to supply the copper required for that. So we had a tremendous copper boom where copper went from 60, 70 cents a pound to $3.50 a pound. Recently, it's been as high as $4.50 a pound. But the problem for the end users is that after everything went into the garbage can in 2014-15 for the mining companies, they decided that we're not going to be in a hurry to mobilize new supply. So there have not been a lot of projects pushed into the development pipeline because of the uncertainty associated with future demand and the memory of how badly things turned out when we over-responded to the China supercycle and ended up delivering more copper than was needed and then suffered the CapEx and OpEx an inflation escalation that wiped out the profit margins. So what's building up now is a future supply deficit. And we're not going to see copper go to $20 a pound or anything like that in like a non-inflationary environment, but we could see a doubling of the copper price from its current $3.50 a pound level, which pulls these deposits that are marginal at $3.50 into the money so that more copper mines can be developed in order to provide all the copper needed for the electric vehicle wiring. So copper projects continue to be of interest, but again, you want to see size and grade. You're not going to just buy some optionality play of 0.15% copper and hope that copper goes to $12 a pound and that this will be in the money, as happened with a so-called aluminum model during the China supercycle. That's not going to happen again. So it will remain a legitimate exploration target metal, but it's not going to achieve manic proportions.
What are you hearing on the uranium juniors?
Well, the uranium juniors after Fukushima in 2011 had a really, really bad period. But last year, efforts were undertaken to increase the spot price of uranium, which had dragged down the long-term contract price for uranium to a point where Cameco shut down McArthur River because it was easier for it to fulfill its long-term supply commitments by buying uranium in the spot market and delivering that instead of McArthur River uranium mined at a higher price than what the material was selling at. So it's been as high as $60 a pound. It's dropped back into the sort of $47 to $50 a pound level. And that has helped spur interest in the uranium juniors, in particular the Athabasca Basin, where we're looking for high-grade deposits that are, $5,000 plus a ton. They put gold deposits to shame. There's now interest in exploring for these high-grade uranium deposits in the Athabasca Basin. There still isn't really any movement afoot to put more nuclear power plants on the drawing board. California has decided not to kill its Diablo nuclear power plant as planned because they're looking at their energy grid and saying, well, we are going to need electricity and we don't really want to resort to coal and natural gas. Well, we'll live with that, but let's keep all the clean energy that we have. And China, of course, is still committed to building lots and lots of nuclear power plants. And it has a solid relationship with Kazakhstan, which is very close next door. And Kazakhstan has emerged as by far the biggest uranium supplier in the world. It's the reason the price ended up below $25 a pound and why U.S. deposits can't work at the grades that they have. And so China will get its supply of uranium from Kazakhstan. But for the other places, Canada is going to be a prime place to find deposits. There's the existing infrastructure. Some of these deposits will deplete in the near future, and developing these other high-grade deposits, that's going to be of interest to the big operators in the Athabasca Basin so that they can supply their allies, especially if Putin's ambitions to reconstitute the Soviet Empire end up including Kazakhstan, and we have all sorts of chaos disrupt that supply. That would send uranium prices soaring if, for whatever reason, Kazakhstan went offline. So it's much better for the uranium juniors than it was a few years ago, but we really do need $60 to $80 a pound uranium as a new sort of solid long-term range for it to be worthwhile to develop these deposits that the companies are capable of finding.
Does it look like gold and the gold juniors are in a downtrend?
Well, the gold price was $16.65 the other day. That's a fair bit off of the 2,000 plus it was earlier this year when Russia invaded Ukraine. And but in the producers and the developers, it has been horrific, the devastation. These companies are down 50 to 70% from their peaks not too long ago. We are seeing CapEx cost inflation. Companies are discovering that their $300 million CapEx is now $500 million, much higher than expected. The stocks are getting crushed. Bought deals are being done at major discounts to market. So it is very, very ugly out there. And again, the point I made earlier about emerging discoveries, if you're sitting on some 0.5 gram per ton gold deposit and hoping to see gold go to $2,500 to drag it into the money, that's not going to happen anytime soon. And of course, gold suffers from crypto, Bitcoin, although Bitcoin is suffering also in this market. It's down 2/3 from its peak not too long ago. For the gamblers that used to buy resource juniors for the leverage provided by the linkage to gold, those gamblers now gamble on Bitcoin trends. So the gold juniors and developers have really suffered as a result of the emergence of cryptocurrency and of gold's failure to really develop significant new real highs. At 1665, it's only maybe 15-20% higher than the inflation-adjusted price from $400 in 1980, which is about $1,400. And given the depletion that we've seen from all the low-hanging fruit in the past 3 decades, we need stronger real gold prices to expand the supply of gold. So if you're interested in the gold sector, you really need to focus on emerging discoveries where you're looking for a grade that's so good that it can work at the gold price that we have right now, without any additional inflation coming into the system.
How does it look for silver and silver juniors?
Well, silver has always been the poor man's gold, and there's been a huge cult built around silver. And I think that cult is ailing these days, because obviously the gold cult has suffered serious attrition due to the emergence of cryptocurrency. So silver-focused stories, they're not getting the traction that they did before. Silver has the benefit that it is an industrial metal. It actually is used for things. Most of the gold, the above-ground silver stock, is fabricated into something, doing something useful. Almost all of the above-ground gold stock is just sitting there in vaults and banks, waiting to be resold to somebody else, being held as a hedge against uncertainty or inflation. And there's lots of research always being done into new applications for silver. So with silver, what you have to watch for is new applications that create new demand, that allow a silver price to go, say, $30 to $50 an ounce. And that's an area where, primary silver projects, they really need that range to be interesting. Most of the silver comes as a byproduct from other mines, and the price that it's at doesn't really matter. It's sort of a bonus. No mine is built just because of the silver content, and that's why nobody, when silver's down, nobody cuts back on the silver production. They just produce it as a byproduct with a relatively low cost and just dump it into the market, which is what keeps silver price from really getting any traction. So the silver juniors, they're also suffering along with the gold juniors in this current market climate.
What's the difference between natural diamonds and lab-grown diamonds?
30 years ago, when I was still working in the brokerage industry as an analyst, diamonds came out of nowhere with the discovery by Diamet of diamonds in the Canadian Arctic. And within a couple of years, an area the size of Switzerland was staked. Juniors have realized that, wow, Canada can actually have diamond mines. And we thought Canada just had kimberlites that didn't have much of any consequence in it. And we had a strong 20-year run that spread to the rest of the world, lots of diamond exploration everywhere. But the last decade has been pretty miserable for diamonds. And because there haven't been that many wonderful new discoveries. And then what also came was lab-grown diamonds. Now, originally they made diamonds through pressure, but that generally made only industrial diamonds, and industrial diamonds were superior to the so-called industrial quality diamonds that you get from a natural diamond mine, because the industrial diamonds are all uniform. But the ability to make gem diamonds, high-quality gem diamonds through chemical vapor deposition, this is a technology that emerged in the last decade, and the proponents of it have argued that, well, these are clean diamonds. They don't have the local environmental destruction. They don't have as big a carbon footprint, but they also can be, an infinite number of them can be manufactured. And if, say, we get an energy revolution like what happened with oil over 100 years ago, or you get much more efficient energy, say fusion becomes a reality by 2035, 40, all of a sudden we reduce the energy input costs dramatically. So the cost of making lab-grown diamonds would go right through the floor, and you would see a superabundance of them. But the difference between a natural diamond and a lab-grown diamond is the natural diamond supply is limited to what was brought up from deep inside the earth by these kimberlite eruptions. And there's been considerable exploration, drilling geophysical targets, finding them all, assessing them, seeing which ones have gem quality diamonds and at what grade can they be mined. So there isn't a lot of targets left to find more natural diamonds. Plus the natural diamonds, each diamond has an internal signature that you can document with an electroscanning microscope, and it's like a fingerprint. And so each natural diamond is a collectible, which is not the same thing for the synthetic diamonds. And they're both, crystallized carbon, so they're no different in that way. But one would be, a lab-grown diamond is sort of like a knockoff of a Van Gogh, can be a perfect knockoff, but it's not the same thing as an original Van Gogh, and especially with new technology like blockchain allowing the documentation of where did this stone come from, that's going to enable the natural diamond market to continue to be reasonably strong in parallel to the lab-grown diamond, where people will buy it purely for cosmetic reasons, but not for this sort of personal satisfaction that you get when you hang an original painting on your wall versus a copy that looks from a distance, looks exactly the same. And in terms of the diamond juniors, they're almost at the end of the line, but there's two major mines in Canada, the Diavik and the Caddy projects. Diavik maybe has 7 years of life left unless they find something additional, and Ekati, it also had a finite life, but they are doing something. They're going back to all these kimberlites that were discovered 20 years ago and reassessing them and even looking around them to see if there were subtle targets that were overlooked. And there's one junior, I won't mention the name, but it picked up De Beers' old Hardy Lake block, and they called it Diagram, and it's to the northeast, and De Beers found a couple dozen kimberlites very quickly within the first decade using older geophysical technology, and also minimal assessment that they weren't large enough. The grades weren't obviously high enough to support a standalone operation. De Beers eventually let them lapse, and the junior staked them when they came open, and it's now mounting a revival using new technology to think about it. And another development from the last decade is the emergence of Type 2A diamonds, which come from very deep, 500 to 600 kilometers deep compared to 150 to 200 kilometers for all the other eclogitic and paroditic diamonds that are usually make up the composition of a kimberlite mine. These so-called clipper diamonds are flawless. They can be very large. And Lucara, through its Caro project, which De Beers at one time had, but dumped, quite low grade compared to the Arapa deposit nearby, it ended up producing these 1,500 carat flawless stones And that's kind of like the hope that maybe the slave, which hasn't really generated any serious evidence of these type 2A diamonds, maybe that's just because the pipes that they chose to develop really never had access to those deeper diamonds, but maybe just off to the side, just like the Caro pipe is sort of not that far from the Orapa pipe. Maybe something like this is possible in the slate, because these large diamonds are so rare that you need to mine to properly identify their presence. You have to do commercial scale mining. And so the micro diamond assessment that was done in the past wasn't really designed to detect the potential presence of such stones. So that's part of the hope of a revival in the Lac de Gras region, taking a fresh look at these kimberlites out there, seeing if some of them have this large diamond potential. And the beauty there is because the infrastructure is already present, and the government and everybody would like to keep it alive, and the company would choose to stave off the reclamation liabilities, you don't have to find a high-grade standalone deposit that can be developed on its own. So I think we're going to see a bit of a revival in diamond exploration in the Northwest Territories as part of the campaign to see if we can keep these diamond mines from shutting down forever.
How many potential bottom fish candidates are you following?
Oh boy, this year is going to be a lot of work, because I look at the price charts. Almost everything's got a ski slope with no bottom yet visible. Last year, or for this year, I had tagged about 150, 160 companies as bottom fish. I think there's going to be more this year. Companies haven't been able to spend their money as quickly as they used to be able to do. Financing is getting tougher to do as this market outlook worsens. But I think we're still going to see a lot of juniors. The one thing that is different is in the past it was easy to pick off the sort of prospect generator types, the ones who always kept the half decent treasury and would use it to generate new prospects and farm them out for somebody else to drill. That type of bottom fish is turning out to be not such a great bottom fish to own, because there isn't money coming into the system right now from more amateur type management groups that don't know how to generate their own prospects, so they create a shell and then farm into somebody else's project. And this market, with its worse than half empty attitude, it's not giving any company credit for having a interesting geophysical, geochemical target. My whole point about the emerging discovery is you get a drill hole into something and it's not quite the guts of the system, but it's telling you you're on the fringes of something potentially very significant that the next few holes could tag into. That's the sort of space where you want to be looking right now. So with bottom fishing, you actually watch these companies, you watch for that news release, and you see the little blip, and then you go in there and check it out. Is this it? Is this the beginning of a new discovery? What's the scale? What's the potential? What's the season? Well, do you have to wait 6 months for them to go back, wait for winter to pass so they can go back exploring? Or can they keep exploring right now? So it's going to be a very fun period in the last quarter of this year, going through all these companies and highlighting those that are emerging discoveries that the market is refusing to give any serious reward to as a result of the news that they were able to deliver this year. And with regard to the lithium space, there's many of the companies that are in the lithium, Eastern Canada lithium pegmatite hunt. They're these blown up companies with hundreds of millions of shares trading below a dime. This is going to be really fun, because if they look at these projects that they may already be sitting on, or go out there and cleverly stake land positions that have potential for this and demonstrate, whoa, we actually have lithium-enriched kimberlite, pegmatites here. And this is going to be almost like, as I mentioned earlier, it's going to be similar to what the diamond boom was like 30 years ago. You're going to see these ratty companies suddenly go from 5 cents to 50 cents and then to $5 as all this external capital swarms into the sector looking to repeat this, because the beauty of the Lithium Mania 2.0 is that one single mine, such as Greenbushes, is not going to take care of the world's lithium needs, because the lithium needs are going to expand tenfold. And that is before they solve the problem of creating a solid-state electrolyte for the lithium-ion battery, which would allow the substitution of lithium metal for the graphite that's in the anode. If that happens, you end up with a really good battery, and you end up with an even much, much bigger future demand for lithium as a commodity to make these electric vehicles a reality.
What are the biggest wins you've had in the junior miners, and where have you placed your most recent bet?
Well, 2016 Arizona mining was the classic win from the last decade. For me, I picked it at 35 cents, 50 cents range. It was an emerging discovery at the time. The market back then in 2015 was even worse than it is today for the resource juniors. And you could see these results coming out, and the only person buying the stock was the CEO. And that ended up being, because they already had, a couple 100 million shares outstanding as a result of spending $40 million to demonstrate that the upper open pitable portion of this system was not worth developing. That stock ended up going about $6.23, which was the price where it was at when South 32 did a $2.3 billion cash takeover bid. So within less than 2 years, this emerging discovery, which was very easy to point out and say, look at this, look at these grades, look at the rock value. This is an emerging discovery. That was an absolute classic. And the more recent one had to be Verde Agritech, which was the last stock I mentioned during our old Discovery Watch series during the last week of December. I said this is going to be my pick for 2022, and it was still around $1 or so at the time. That hit $11.50 early this year. Right now it's under pressure because they've had to revise their guidance downwards as a result of not getting their plant completed in time for a key selling shipping window, but it still remains one of my favorites to become my all-time winner, because with the numbers that you see from their alternative potash product, K Forte, in Brazil, ultimately replacing maybe 50% of Brazilian potash consumption, which 90% of it is currently imported from other countries like Canada and Russia. That stock remains one that could be, down the road a $50 to $100 stock if they are successful in becoming 50% of the market. And the most recent stock that I placed a meaningful bet on would be Brunswick Exploration, which is actually Bob Wares, who was part of Arizona Mining and told me, hey, take a look at the Arizona Mining. Through Brunswick Exploration, he and Killian Charles have created a team that has been going all over eastern Canada, looking at all these places where these lithium-enriched pegmatites potentially exist. While most companies pick an area and stake property and then try their luck to see if there's something such as what Patriot Battery Metals has with its Corvette project, try and get a winner out of that. They are doing this on multiple fronts. They're not saying too much about anything that they're doing at the moment, but by the end of this year, they will have unveiled a smorgasbord of all kinds of projects in eastern Canada, some of them which you can work year-round, and then they shift into the exploration drilling and hopefully delineation mode and show us that they have not just one major pegmatite discovery, but multiple different pegmatite discoveries. And that would turn this thing, which, has 150 million shares out already, it's 30 cents, 35 cents now. That could turn this into another major success. It's not going to be a $50, $100 stock because, such as Verde Agritech, because it has, a lot more shares outstanding and will have to raise more money to execute its plan. But when you go from 30 cents to, say, into the $5 to $10 range over a 3-year period, as you demonstrate that, hey, we have the goods to help make your EV dreams a reality, this is the time to look at this, because Lithium Mania 2.0 is not yet really acknowledged, but you can see all the signs, all the guys who are into, cannabis and crypto promotions and that. They're getting their shells, and I'm getting calls from people saying, if you know of a good lithium project we can acquire, let me know. So the system's gearing up for Lithium Mania 2.0, and Brunswick Exploration is my current favorite in that regard.
How can people subscribe to follow your bottom fish candidates?
You just go to kaiserresearch.com and either register for the first time, or if you remember your password and login name, update your account and submit your credit card information. $4.50. I think I'm finally going to come through on my threat to increase the price significantly for 2023 and beyond. So the next few months would be a good time to get on board and be grandfathered at the old price, especially if we do end up with Lithium Mania 2.0, and I've got all the companies tagged with their projects. You can go in there, search, find them yourself, figure out which one are the ones you are going to accumulate, or you can just follow the ones that I spotlight and sort of say, like Brunswick Exploration, well, here's one, you buy it now and just watch it and see how much money we make as Lithium Mania 2.0 unfolds.
John, thank you so much for being on This Week in Money.
You're welcome, Jim. Thank you.
My guest has been John Kaiser, publisher of Kaiser Watch on kaiserresearch.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and John Kaiser. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. Now stand by for a company showcase tribute to the late CEO of American Manganese, Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Žarko Masalgia, Chief Executive Officer of American Manganese, doing business as recyclable battery materials. Welcome back to Company Showcase, Žarko.
Thanks, Jim.
Žarko, very, very sad news for people in the mining industry, the recycling industry, and personally, for me and all of us here at House Street, the sad news of the passing of Larry Reaugh, Chief Executive Officer of American Manganese.
Yeah, it is really truly a sad time for our company, and we want to dedicate this podcast to the man that started it all, Larry Reaugh. The kind of commitment and dedication he had for his work and vision is truly inspirational. Where nobody really dared to explore, you'd find Larry finding a way forward, and with incredible resilience. Even with these podcasts. I mean, nowadays it feels like everyone has a podcast, but Larry's been doing them weekly for years, and I found it impressive enough that the man his age knew what a podcast was. But throughout Larry's career, he has gone through ups and downs, even literally in the markets, but he never gave up and served in the best interest of the shareholders with unwavering loyalty. And even when the company's Artillery Peak project didn't move forward in 2012, and the stock price would trade as low as 2 cents, Larry held on, even though he had to make some personal sacrifices. And what's most amazing is how calm he would be through it all. It's really truly something that cannot be explained and really has to be experienced. Even when the world, went under the lockdowns due to the pandemic, Larry walked into the office the next day without hesitation and never missed a single day because he knew the work needed to be done. And he always had many quotes to share, and I would always actually write them down. So I was looking through them the other day, and I probably shouldn't repeat some of them on this podcast, but one that he would always say is, worrying is debilitating, and if worrying worked, I would worry. It's a good lesson for everybody. But if it wasn't for Larry's sacrifices and dedication, he would have never. I guess we would have never had this exciting opportunity to exist for this company in a revolutionary field of work. And there, even when we look now, there are dozens of companies focused on lithium, nickel, or cobalt mining, or whether it's producing advanced battery materials or lowering carbon emissions. But Larry's vision, brought to life a company that spans across these areas and really creates a practical, circular solution. And Larry has been an incredible friend and mentor to me, and it's really an honor to work with him and learn from him. He really deserved to see the massive success I believe this will be, and I want to ensure listeners that his vision will be carried out. Larry has built and put his trust in an incredible team, and a few of us would like to say some words. So I'll first pass it on to Teresa, who's the corporate secretary, and then that'll be followed by Shahim, who's our CFO and director, and lastly, Paul Hildebrand, our interim board chairman.
Hi, Jim.
Hi, Terry.
Hi there. Hi, everyone. This is Teresa Purin, corporate secretary of American Manganese. It was back in January of 1986 when I received a call from a temp agency I was with to go for an interview at Reaugh Corporation. Larry met me with a strong handshake, a big smile, wearing his iconic leather jacket paired with a fanny pack. This was just the start of a 36-year-long working relationship and friendship. He was the godfather to my first daughter. We shared many great memories and accomplishments together, including the Gold Ray Samatosum silver mine opening and the Adnak molybdenum project up at Ruby Creek. Larry taught me everything I know about the mining industry. He was a wonderful and generous boss, a great mentor and a dear friend, and I will miss him greatly. I'm sorry. I'll miss him, really, really will miss him. I'm sorry, but it's very emotional when you're trying to remember your friends, and I'm just verklempt. So I'm just going to pass off to Shahim.
Thank you, Terry. It has been hard on Terry for the last few days. Terry has been with Larry for over 30 years, probably the longest serving staff here at the office. Hello, everyone. This is Shahim Ali, CFO at American Manganese, doing business as now Recyclical Battery Materials. It has been heartbreaking and tough last few days. Here, as we say goodbye to Larry, our founder, CEO, and mentor. Born and raised in Cache Creek, BC, Larry loved his telling stories and his cowboy boots. I have been with Larry for over 10 years. Larry was a visionary and demonstrated exceptional entrepreneurial mindset. Always puts his work first. Larry has been taking care of his health last few months. His last days were spent in a rehab facility in South Surrey to gain muscle strength after a heart surgery. Paul Hildebrand and I visited Larry this past Monday, and I will never forget Larry's chuckle at old mining stories and how he navigated both the good times and the market storms. Larry always put tremendous energy, and he has put so much into Recyclico, and we realize we have big shoes to fill. I wanted to thank all the shareholders, friends for your condolences. We are in touch with family on a daily basis with your messages, and we have been providing support to the family every day. As I say goodbye to my captain, I wanted to share his famous line with you all. He had this line tagged to his monitor in the office. It said, "Life is a sucking cesspool of despair." It took me a long time to understand what he meant, but over the years and today, I get it. This weekend, Zaka and I leave for New York to speak and network at the Reaugh Motion EV and Battery Energy Transition event, which is held next week in New York to keep working on Larry's vision. And we are destined to fulfill his dreams. Thank you all. Thank you for your support. Now I will ask Paul Hildebrand to say a few words. He's our new chairman of the board.
I met Larry in the mid-1980s, so we knew each other for almost 40 years. I knew him through good times and bad times, and times when markets were strong and times when they were weak. The one thing that always struck me about Larry is that even in the most difficult times, he never complained. He never tried to put the blame on the rest of the world. Larry's response to adversity was just to put his shoulder to the wheel and push ahead. And that's something I always admired about him. And I hope we can show the same kind of fighting spirit at Recyclico now that he's gone.
Thank you very much, Paul. And on behalf of myself, executive producer Tom Allen, and executive assistant Kim Russell, we'd like to extend our sincere condolences to all of you and to Larry's family and friends. Larry Ray will be greatly missed by all of us. And now we'd like to end the podcast with something Larry and I did every interview over the last 5 to 7 years, every week. One last time. For people who want to know where you're traded and get more information about the company, where should they go?
Well, we're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. QB board under the symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. And you can get any information you want by going to our website, because we try for transparency. And you go to our website at AmericanManganeseInc.com.
Larry, thank you so much for the update.
You're welcome, Jim.
This interview took place on September 23rd. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.